On Wednesday, Federal Reserve officials announced that they are cutting interest rates by 0.5 percentage point. That is a large interest rate cut and the first in more than 4 years. The Fed is saying that it's no longer trying as hard to slow the economy in order to bring inflation under control, because inflation has been steadily falling for months now. Interest rate cuts are definitely good news for the economic vibe and the way that people are feeling about the economy for two big reasons. The first is that people just don't like high interest rates. They make it more expensive if you want to borrow money to buy a house or to buy a car, and they just feel like another cost. The second is that this can really sort of help to shore up the economy over time. Lower interest rates mean that demand could recover and be a bit stronger than it was, and that means that the labor market's more likely to stabilize without cooling sharply from where it is today. That's obviously good news for people who are working and hoping for wage gains and experiencing this economy every day. The Fed is really dealing with two big risks as it thinks about how much to cut interest rates and how quickly to move going forward. The first is that if they cut interest rates rapidly, there's a risk that the economy could pick up really quickly, and that would result in potentially sticky inflation. It would keep inflation stuck at its current level. Risk number two is sort of on the opposite side of the ledger. If they keep interest rates high for too long, you could see a situation where the labor market starts to slow down really meaningfully. And you talk to some economists who are worried about this at the moment, because we have seen unemployment really creeping up in recent months, and we've seen job gains really starting to slow. And so I think the concern is that if the Fed is too patient here, if they are too slow to remove the high interest rates that they've been using to hold down the economy, you could see the economy not just sort of slowly decelerate, but actually move toward a more painful crash. So a half-point rate cut really signals that the Fed is a little bit worried about the job market. Typically, the Fed moves in quarter-point increments, so a half point's a little bit bigger of a step, and it's a signal that they're trying to take their foot off that economic brake pedal a little bit more quickly to make sure that they provide some cushion for the economy and that things don't keep slowing down in the job market and in the economy overall. When the Fed lowers interest rates, it helps to speed up the economy, which is generally good for the incumbent party who holds the White House. The Federal Reserve is not a political entity. It does not set rates based on politics, but its rate setting can absolutely affect politics. The fact that they are cutting just before an election really sort of plunges the Fed into a political limelight that I think they would probably prefer not to occupy.